Good morning to one and all present here. Myself, Dr. T. Ramesh Kumar, Department of Commerce with Computer Applications. Today, we can discuss financial accounting. In this financial accounting, we discuss about depreciation. So, first of all, what is depreciation? Depreciation is a permanent decline in the value of an asset. The gradual improvement both in the value and usefulness of an asset due to its nature and usage is termed as depreciation. It is common experience that whenever an asset is used, it reduces in value. The net result of depreciation is that sooner or later the asset becomes useless. So it can be stated that depreciation is that portion of the cost of an asset which is reduced from revenue for the services of the asset in the operation of the business. Definition of depreciation. According to the Spicer and Pegler, depreciation is the measure of the exhaustion of the effective life of an asset from any cost during a given period. Next, we can see objectives and necessity for providing depreciation. It is a true profits apportionment. The first one is apportionment of true profits. When a particular asset is used for the earning income of the business, the reduction in the value of an asset should be provided from the income in order to calculate the correct and real income of the business. Depreciation is an invisible expense, so it must be charged to the profit and loss account. Second one is presentation of true financial position. If depreciation is not provided for, the balance sheet will not disclose a true and fair view of the firm's state of affairs, since the assets will be shown at figures which are in excess of their true value. Next, replacement. The amount debited in the profit and loss account in the business, there are available for replacement of the asset when its life is over. So by making an annual charge for depreciation, a concern would be accumulating enough resources to enable it to replace an asset when necessary. Fourth one is no distortion of divisible profits. If depreciation is not charged to profits, trading result are vitiated and divisible profits are distorted. Hence, the joint stock companies must have to provide for depreciation before declaring dividends according to the Companies Act 1956. Next, methods of providing depreciation. The first method is straight line method or fixed installment method or original cost method. Under this method, the depreciation is charged evenly every year throughout the effective life of an asset. In other words, a fixed proportion of the original cost of the asset is written off each year, so that the asset account in question may be reduced to zero or its residual value at the end of the definite period representing its estimated life. So the amount of depreciation is calculated as follows: depreciation equal to cost of fixed asset minus estimated scrap value, number of years expected life. Next, we can see second type is diminishing balance method or reducing installment method or written down method. In this method, depreciation is charged at fixed rate on the reducing balance. There is cost less depreciation every year. In other words, depreciation is calculated at the book value the asset each year. Thus, the amount of depreciation goes on decreasing every year. Under this method, a fixed rate percent on diminishing value, that is book value, of the asset is written off each year. So, as to reduce the asset, it break up value of the end of the life. Depreciation under this method is heavy of the earlier years of the asset's lifetime and negligible in the later period of the asset. Next, third one is annuity method. In this method, interest at a fixed rate is calculated on the capital investment involved in the purchase of the asset, on the assumption that if the same amount of capital was employed in some other investment, it would have earned a certain rate of interest. The owner of the business, therefore, during the period of the utilizes any asset, not only losses the original cost of the asset in the shape of depreciation, but also losses the interest thereon. Under the annuity method, the cost of asset as also the interest thereon and written down annually by equal installment until the book value of the question reduced to either zero or its residual value at the end of the usefulness of the business. The fourth method is depreciation fund or sinking fund method. In this method, the amount of depreciation is calculated with reference to sinking fund. It is debited to depreciation account. It is debited to the depreciation account and credited to sinking fund account. At the end of the year, the depreciation is charged to profit and loss account. The amount is invested in outside securities in order to earn compound interest on the investment. The fifth one is insurance policy method. In this method, A policy is taken for the amount of the asset to be replaced. At the end of the policy period, a definite amount is received from insurance company which is used for purchasing new asset. Premium is paid every year and this premium is equal to the amount depreciation of each year. In the beginning of the each year, premium is paid. Thank you.